Good evening, everyone. Good evening, everyone. A very warm welcome to all of you. I'm CA Anirudh Rathi. First of all, thank you for giving me this opportunity to be an MOC, that is Master of the Conference, for today's webinar. Also, it's a great pleasure and honor for me to pronounce that today we are joined for a day 6 of 6 days virtual investors awareness program organized by Pune branch of WIRC of ICAI. I welcome CA Samir Ladda, Chairman and Treasurer of Pune ICAI. I also welcome and thank to CA Kashinath Pathare, Vice Chairman and Secretary of Pune ICAI. I just came to know before a few minutes that they could not join the meeting due to official reasons. And most importantly, we are having CA Vinit Deo with us, who is a speaker for today's webinar on the topic Introduction to Investments in Startups. So now it's my absolute pleasure to give a brief introduction about our today's speaker, CA Vinit Deo sir. Bringing in a robust experience of 2 decades in the field of finance and advisory, Vinit leads the PosiView consulting team in being growth partners for the emerging Indian companies. He has led the closure of over 100 funding and 200 advisory transactions from a few to a few hundred crores. He has corporate experience with Times of India Group and Geometric Software Solutions. He has led PosiView to become a preferred advisory partner to real estate developers. He is a regular contributor of articles to media such as Times of India, Money Control, Sakar, etc. And he addresses sessions on topic of fundraising, RERA, business opportunities, etc. He was selected as professional icon of Pune by Lokmat in 2016. He is active in the profession and was a managing committee member and vice chairman of Pune chapter of the Institute of Chartered Accountants of India, as well convener of the WIRC COVID-19 Economic Response Task Force. He actively works with industry associations to submit representation to the government on policy ideas. He is on the investment committee of the Center for Innovation, Incubation and Enterprise of Savitribai Phule Pune University. It's a pleasure to have you with us, CA Vinit Deo sir. And now I request Vinit sir to kindly proceed further on his today's topic, that is Introduction to Investments in Startups. Over to you, Vinit sir.
Thank you so much, C. Anirudh Rathi, for that kind introduction. Thank you, my dear friend and our dynamic chairman, C. Samir Ladda, and Vice Chairman, C. Kashinath Pathare, for inviting me for this session. What I'll do is I'll share my screen for the presentation. Aniruddha, is my screen visible?
Yes, sir, it is visible.
It is visible. Okay.
Yes.
Thank you. Yeah. Right. So what we'll do is we'll try and keep it interactive as possible. It's an exciting topic. It's a great professional opportunity for anybody who wants to enter, and we'll look at some very, very practical aspects. And even before we jump into this introduction to investment in startups, I want to speak for a few minutes on, why as a professional, we can all look at this as an opportunity. Like the way when a GST comes or a FEMA, comes, when these acts, for example, come in, we study them, we evaluate them, and these are all professional opportunities for us to work on. Similarly, something like startups, it's not as if, there's of course amendments in income tax where you get income tax benefits and so on. But this doesn't become an apparent opportunity because there's no regulatory change involved. It's just a change in the market due to which this comes up. But over the last decade or so, there's been a massive increase, especially since 2014 when the Startup India scheme was launched and the word startup first entered the official jargon, where of course there were startups before that. For decades there have been startups. So in a sense, in 1990s, for example, or 1980s, Infosys was a startup of that era. And in a sense, they started this culture of outsourced IT development and so on and so forth. And companies then like Wipro and TCS and so on of that era, Patni Computers, etc. They were in a sense, you cannot really call in a sense TCS a startup because they were backed up by a large group like the Tatas who were pouring in the money. But something like Infosys was a startup. That idea was new. Promoters were putting in, and we've all heard stories of how Mrs. Murthy's jewelry was mortgaged and hypothecated, and some loan was taken and so on and so forth. So those legendary stories we've all heard, which speaks about the risks involved, and obviously the rewards are there today for all to see. But from that, approximately that time onwards, we've had this thing of people other than established industries, industrialists, setting up companies, and they growing to become hundreds and thousands of crores worth of companies. Many companies that we see right now, even in common parlance, for example, Just Dial started as a very small company, and so on. So there are tens and tens of such companies. Be it Meru Cabs that we would have boarded, or for example, Captain Gopinath's Air Deccan was a startup where he revolutionized aviation. Big Bazaar, that is Pantaloon Retail, was a startup which revolutionized retail trade and started that culture. So there are many companies which started small and they grew to be hundreds and thousands crore worth of companies. And interestingly, when they started, it would not have seemed to the people around them, be it their chartered accountant, be it their ecosystem, that they could potentially become such large companies one day, because they are going after new concepts, new ideas, and nobody knew what would happen. So imagine if their ecosystem, people around them, be it employees or professionals, be it a company secretary, etc., would have recognized, and many would have recognized, of course, how large they might become, or the fact that they are growing. So Infosys in earlier was really doubling every year, for example. So the reason I wanted to give these examples is that when we look at startups right now, many times it looks like a company which is not even revenue generating, which is 1 lakh rupees of revenue, loss making, and so on and so forth. But I wanted to start off by giving you examples that at that point of time, the companies that I took names of were startups. And of course, there'll be equal number of companies which would have failed during the journey. And we'll talk about that during the course of this chat as well. So for every company which became a 1,000 crore company, I'm sure not just 99 companies either would have failed completely, made losses, or may have just become a few crores or few tens of crores worth of it. That also happens, actually. So we'll look at how to identify companies, what to look for in companies, and so on and so forth, because the subject is introduction to investment. As I'm speaking, let me also keep my chat window open. So if some of you want to type some comments, observations, even practical stuff that you would have come across with your own clients, feel free to just ping there, and I will in between look at these comments and take them as a part of the discussion. So feel free to keep on putting up stuff that you may have encountered, issues that you may have encountered. I'll try to cover as many things that I have come across in my professional life, because in the last 15 odd years, every single day I've spent meeting either an entrepreneur, an investor, or doing a call with a fund, and so on and so forth. That's all. We don't do any audit work, any tax work. So all of the work that we do is with enterprises. Of course, not all are startups. Some are mid-stage, late stage, and so on and so forth. So we'll cover some of those case studies as well. And those might help you to look at your clients in a new light. Okay, before going ahead, I'm pretty sure that everybody, all of these 75, 80, I don't know, the number might have increased now, participants would have at least one startup, okay, in your portfolio, or somebody would have approached you. You may or may not have taken up the work, or in your ecosystem, or inquiring to you and so on. It's just not possible that in a place like Pune, you haven't come across in one or the other way a startup, because there are 8 or 10 hubs of startups in the country. Like there are like manufacturing bases. In manufacturing, there is Kolhapur, Ichalkaranji, Satara, of course, Pune is one, Chennai is one. So there are these Nashik and so on. So like there are hubs of manufacturing, there are hubs of IT. In India now there are hubs of startups, and they have emerged for some peculiar reasons. Pune is one of those hubs. Bangalore, of course, is number one. There's Gurgaon, that is the entire NCR region. Then you've got Hyderabad, which is very strong. Bombay, in fact, in that sense, is equal or to an extent lesser than Pune, or maybe just equal to Pune in terms of the quality and so on and so forth. And of course, there is Pune. So you don't see too many of these startups coming from Nagpur, Nashik, Kolhapur, and so on. And we'll get into reasons as well for that. But I see that many of these will start coming in the time to come. So I think there's something to watch. If I miss out, somebody please remember me that we'll talk on tier 2, tier 3 cities and what's happening there and what could be the opportunity there. But yes, for now, there are these centers which have emerged. Peculiar, and Pune is one of them. So we are part of an ecosystem where there would be startups around us. And predominantly, the reason being that all of this revolution around startups started with IT startups. So all of these case studies that we hear right now are technology-based startup. And when anyway you talk of the word startup, the word, typically it is interpreted as a tech startup. You presume it's going to be something to do with an app, something to do with e-commerce and so on and so forth. That is because the volume of, the publicity that they have got, a Flipkart, an Amazon, and all of these, Lenskart, or all of these companies basically is phenomenal. So that presumption is there. We'll talk also later on how that scene is also changing as we go ahead. And because these were when the revolution started, these were mostly tech-based startups. To an extent, there were some pharma companies and some, partly some manufacturing companies and so on. But yeah, principally tech companies. They emerged at places where there was already a strong technology presence. So places like Bombay, Hyderabad, Bangalore, Pune, all of these places, as we all know, have two things in common. One is very strong educational culture, lots of colleges, universities, engineering colleges especially, and two, a very strong IT companies base. So it is people who step out from these IT companies who in fact set up these startups. So who will set up a startup? Either somebody who's from engineering college, a young guy, or somebody who's got a few years of experience in an IT company. So because you had so many of these IT companies in these places is where these places like Pune and Bangalore, as I said, became the hubs, the first hubs of startups, and the tech development started. So in Pune, we have places like, we've got now unicorns, billion-dollar valuation companies like iCertis, Dhruva, and so on and so forth, which are, or for example, you have e-commerce companies like FirstCry, which have emerged from Pune. Anyways, so that's how these places become, and that's the reason I'm saying that if you've got clients who are working in IT, who might be an employee, who might be spending a few years there, might be discussing ideas, I think you need to look at your client base, not just the business client base, but also the professional client base, because many times you may have a client who's an IT professional, 10 years experience, 15 years experience, 25 years experience. Now, these are the clients who ultimately step out and then start some kind of a entity. The good chance that they will start up something, or they might be in an ecosystem with their friends starting something. Now, if they know that you also give services to startup, be it setup, LLP, company, and you are aware of what is needed for that, there's a good chance that they will refer either they themselves. Obviously, if they're a client, it's a different thing, but they might refer you and introduce you to some such companies if they are aware and you're talking to them in that language, you're sending them updates on what is happening in this space, etc. Now, this is about the tech part generally. And that's the reason I said there's a good chance that within your clients or in your extended set of clients, you will have a set of startups which are incubating right now as we speak. And perhaps you will only have some of them as clients and some will be right there. Okay. Now, before we jump into startup, is there a formal definition of startup? When I say startup, what is it basically? So what I've tried to capture is there is of course a government definition, but we'll talk about it in a few minutes. A startup, see, basically any company if you start, a simple LLP proprietorship private company, okay, is technically a startup. Any new business entity is a startup, correct? But we are looking at startups from a very specific angle. When I am calling something as a startup, and then we are saying it is, in common parlance, in business parlance, what do venture capital funds, what do these tech guys, what do business people call a startup? Okay, so there are 4 key factors that I found are typical or common to all of these startup founders or startups. Number 1 is they are creating innovative products or solutions. You will also find startups where these are not fully innovative. Okay, they are copy paste or something. So, for example, Flipkart, is it a really innovative kind of startup? No, Flipkart basically was Amazon there before Flipkart started. Yes. So it is an e-commerce platform. Of course, the business model might be different, the engine might be different, and so on. But in a sense, it's not really innovative. Or a Zomato may not be innovative. For before Zomato, there would have been listing platforms for hotels in the US long back. So in that sense, many of these e-commerce platforms would not be unique in a sense that there would be models prevalent out there. I think somebody wants, yeah. I think Mr. Sabre wants to ask a question. Yes, please go ahead. Mr. Sharad Sabre, CA Sharad Sabre wants to ask a question. Please go ahead. I think one more person has raised a hand. If you want to ask a question, please go ahead. Okay, I'll continue till then. So 4 characteristics of startups. Although I'm saying I'm immediately giving you a corollary also or a contradiction also as to why, even if it's not an innovative product or solution, it can still be a startup. But typically, in a sense, they are trying to do something which is innovative into either a product or a solution. One very important characteristics of all of these founders is, unlike a typical, you also will have clients which is a manufacturing company, doing some production for a telco or a Bajaj, or doing some products, etc. But what separates a startup from is that the ambition of the promoter is to be a market leader. Okay, it might be, and that's why I say it might be in its segment basically that it wants to be a market leader. Mr. Sable, you want to ask a question? You're raising your hand. Okay. So that's the second characteristic. Third characteristic is they are targeting continuous growth. And why this is important, you see a lot of news lately that so and so companies' loss has increased from 100 crores to 200 crores and so on and so forth. But so startups typically, and we'll discuss this later when we are evaluating, that their focus is to grow very large. Profitability comes later. Whether that is right, wrong, etc., is a separate debate. As chartered accountant, we understand every business should run for profit. If not today, break even it has to achieve after a certain time. And yes, the objective of startups is also obviously to earn a profit and so on and so forth. There's a question which has come up. We'll take it slightly later. How can one? So yeah, I've noted the question from Dipti Thakar. Okay. So these entrepreneurs, when you talk to them, they will see they'll be targeting continuous growth. That's the language that they would be talking. And last and very, very importantly, a normal businessman would be talking of revenue growth to an extent and profitability. That last year I made so much profit margin. I made 1 crore profit. This year I'm making 1 crore 20 lakh profit. My loan is going down. My assets are increasing and so on and so forth. This is the language that a normal businessman will be speaking. A startup's complete focus is increasing its value and valuation for shareholders. Of course, it comes through increasing customers, customer base, and so on and so forth. But the focus is increasing the valuation. So these are the characteristics that separate what we call as startups in a commercial parlance, in a normal parlance, from just any other company, from a manufacturing company which is maybe growing 5-10% year or year, and so on and so forth. A startup will say, no, I want to be a leader in Western region. I want to be a leader in frozen foods. I want to be leader in e-commerce, or if not number 1, number 3, or in the top 5, or whatever it is. For that, I will continuously maybe raise capital. I will acquire companies. I will do marketing. I might incur losses in the short term or for 4-5 years also. But my target is that if I become a few 100 crores company, then my valuation become so and so. Why would my valuation become so and so? Because comparable companies which have grown to be of that size, unka valuation is similar. So this I wanted to tell you, what do you typically call a startup? There is a government definition as well that has come in the picture, which is Department of Industrial Policy and Promotion, whereby they call these recognized startups. So basically it has to do with turnover less than 100 crores, focusing on innovation, development, and basically products or services, and it is not formed by splitting up or reconstruction of any existing business. What happens is, the reason that the definition is there is, and it has to be either a LLP or a private limited company, there is an interministerial board of certification. What happens is, there is all the CAs would know that there is income tax benefit for startups. Now, to claim that benefit is not available for all the startups, it is available for recognized startups. So the government checks. So tomorrow, for example, I have a startup which is into trading of footwear, for example. Now the government may not qualify for the criteria of innovation, etc., that the government feels. So who decides whether it is genuine innovation? Because they want research and development, R&D, pharma, new product, defense, manufacturing, or even in tech, some new tech, etc. So if those things are happening, then general recognitions are being given. So they have set up, if you see the interministerial board, it is DIPP, Biotech, and Department of Science and Technology. So their representatives sit together and decide. It is almost like granting a patent in a sense, whether it is genuinely innovation. So as I said, innovation can be in various forms. Of course, there need not be a patent in the first place, but the IMBC should say that this is innovation. If that certificate is granted, then you get income tax benefit also. So we are, just because it doesn't have this recognition doesn't mean that it is a startup. Part of the startup subset will get this recognition. Okay. There's a question from CA Dipti Thakar. How can one invest in startups? What's the minimum amount of investment? There is no minimum amount of investment as such. It can be 1 lakh rupees. It can be 1,000. So it is like investing in any new venture. Okay. So there is a company which wants to raise capital. It's a private contract between the company and the investor. Okay. 1. 2 is how part I have covered in one of these slides. So we'll tackle that in a brief while. Okay. So before how, let us, if you are advising a client, or you might get 2 kinds of professional opportunities. Opportunity 1 is a startup coming to you for services. It could be your regular services or fundraising services. So we'll come to the fundraising part later. Or a client coming to you, like somebody has asked that I want to invest. So what should we tell him? What are the pros and cons of investing in startups? Okay. So let's tackle that aspect. Number 1 is it has got startups, as the reason I gave you the examples of Infosys and Zomato and so on, as you've seen it, they have got unlimited growth potential. If you recall, in one of the slides, when I said how do you define startups, I had said, okay, these founders are chasing unlimited growth. Okay, so that is the reason that there's unlimited growth potential. They are never satisfied. They always want to grow. Agar India khatam hua to abroad jayenge, like Byju's, for example. They are capturing India. Now they are saying we'll go to Brazil, and Zomato is doing similar, and so on and so forth. So that is the way it works. So if you are advising a client who has got money as to why it makes sense advising startups, now that's number one. Number two is playing the role of, so this person who is investing, he can play the role of a advisor, a mentor, a director. So because these startups will also need senior people on their board. So if somebody is putting in money, your client is putting in money, for example, he can be on the board of directors, or he can be advisor to them. That itself gives us of course, it gives a certain status and respect and so on and so forth, and it gives some more benefits we'll just see. But sometimes at a certain stage in their life or career, they also want to explore new opportunities without leaving an existing job. So somebody who is 15-20 years in IT, there's that job fatigue as well. They want to explore new opportunities. They want to learn more things without leaving. So this is a good opportunity by investing. Typical investment by an angel investor, and an angel investor is somebody who puts the first money in a startup. He virtually comes like an angel, so he's called an angel investor. So you can put as low as 5 lakh rupees to 10 lakh rupees and start investment in a startup. So with that, you can go on a board. So it is virtually like starting a new business on your own, where you have a founder who's running the business and you are advising. So you also get that professional satisfaction, and you get a seniority, you get a respect and so on as well. If you are part of, or your client is a part of the startup ecosystem, you can get professional opportunities there. So for example, imagine a person who's on the board or is an investor even of a startup associated with the startup. Then the startup may, in addition to the investment, professionally may want him to consult on certain matters. The startup can then connect him or suggest him to other startups or other people in their network, that this guy has got expertise in this area, why don't you take his advisory services, etc. So that is the advantage that you can get by being in the ecosystem of startups. Then very, very importantly, the world is moving very fast. Technology is moving extremely fast. And you can be part of that domain. You can be very much there in the field, where if you are an investor in a startup, then you are aware of what is going on. You are learning continuously. Your own knowledge, your own expertise is going up, etc., which can help your own business, profession, or job. So because you are at the cutting edge of things effectively. Lastly, your own knowledge. So as a chartered accountant, either if you're investing or advising, or your client is then you can continuously see, there are lots of things that you can parallelly study. There is things like tax planning. There are things like setting up MIS systems, financial planning, budgeting. A lot of that knowledge can be applied, because these startups are mostly technocrat promoters, be it IT or any other field, and it helps, and they need this kind of expertise. So your knowledge, as well as I said, your client's knowledge, can be applied there. So this is the background for or the reason for investing in startups. I'm just checking if there are any questions. Okay. 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 At the same time, you should also know the risks of startup investing, which is number one, it's a illiquid investment. So when you subscribe to shares, or if you put money in LLP as capital, as partners capital, or in a private limited company as share capital, you need to understand that there is no, obviously these are not listed. Nobody else is going to buy them. So it's completely illiquid. So that's something that you should advise your client. Connected to this is, chalo, liquid hai, but what is the timeline? So although the startup will make a business plan that 3 years, 4 years, 5 years, this will happen, and so on and so forth. There's no guarantee. Practically speaking, if you're asking someone to invest in a startup, you have to tell him that it is completely uncertain. Okay. Also, let me talk about exits here itself. You also need to know that what are the forms of exits. Let's cover it. If somebody is like put in the money, so generally you will not get monthly quarterly returns because you have put money by way of share capital, not by way of debenture. I mean, the format might be debentures or compulsory convertible preference shares and so on. We'll get to that. But this is principally risk money. So how do you get an exit? You get an exit typically by the next round investor buying you out. There are 3 modes of exit that you have. You invest by way of angel capital, and along with you, let's say if you put 5-10 lakh rupees, your client has put 5-10 lakh rupees, and let's say 8 or 10 such people have come together and put about 1 crore of rupees in the company. Company is operating and so on and so forth. Typically, this round is called as the angel round. Then after that, or a seed round, because you are seeding the company. It is literally at a seed stage. I want you to understand and absorb this terminology if you do not know, because if you open up Economic Times and Mint and so on and so forth, this is the terminology that you'll see, that so and so company raised so and so many from angels, or raised so and so many as a part of the seed round. So it means typically the same. The difference is that a seed round is literally at a time just after formation of a company, or few early months and so on and so forth. Of course, the company, it's not literally at a formation stage. Company has been formed, some beta version is there, some product is there, some work has started, etc. But very early in the life of the company. That is called as a stage when there is a lot of risk, a lot of uncertainty involved, etc. That is called as a seed stage. And that seed round can happen through a venture capital fund, a VC fund, or it can happen through individuals who are called angels. So that's the reason that a seed round may be done by angels. So if a seed round is done by angels, it is also then called as the angel round. That's it. Okay. So now these angels, when they invest, typically after 6 months, not 6 months, typically 1 year, 2 years, when the company grows, then the promoter goes to the fund. The fund, when he puts in the money, typically then doesn't want so many shareholders or partners in the company. So they're like 8 or 10 people, because it's a risk to them that tomorrow somebody might object to something and so on and so forth. So then they might say that we will put in the next 2 crores, 5 crores, whatever that is. But these people who have invested 1 crore, we'll give them an exit at a valuation which is there at that point of time. This may happen, may not happen. This may happen fully or partially. So depends on the situation at that point of time, at the time of second round. So only when such a fund comes in, will your client or the investor get an exit? And even then, it's not guaranteed. There's a good chance that at the first round you may not get exit. At the second round you might get an exit. So that is more likely to happen than the first round, because in the first round the investor coming in will say he also doesn't put a lot of money. First round investor also might put typically $500,000 to $1 million, 3.5 to 7.5 crore rupees. And then they will say that we don't want to give exit. We want to put money in the company itself. So that is something which might happen, and you may not get an exit. So you have to wait for 2 to 3 years at least before even logically there's a chance of getting an exit. You might get lucky and the company might grow very much in first 1 year and 18 months and immediately get an exit. That's a different thing altogether. But typically you will have to wait at least for 2-3 years, and the company has to be doing enough for the next round of investors to have interest in investing in the company. That is one way that you get an exit. Second way that you get an exit is some other company buying you out. Now this company might end up creating great technology, product, etc., and the promoter also might be willing to sell. So that might happen where there's an exit through a strategic sale, and then everybody gets an exit. Third, which is like a long shot, can take a long time, is basically a IPO of the company. But that, of course, is a very rare instance. After 500 companies, one might get to a stage where it is large enough for an IPO. And that typically, if you see, even Zomato took 10 years, for example. So to be large enough to go to an IPO, you might then have a 7, 8, 10-year kind of a horizon, possibly. So that is something. These are the 3 modes of exit. So what I want to say is exit is not easy. Okay, please note, please educate people, the investor, that there's uncertainty, and there's also what you don't get generally is you don't get an interest-like feature. You don't get regular returns. What you get is an exit by way of increase in value of shares and somebody exiting, one. And also you don't get your capital back or something of that sort. It is somebody else who is going to buy your shares. Typically the promoter buying shares, etc., is a very rare instance, or the company buying shares is a very rare instance. Doesn't happen generally in my experience. Okay. So we've spent time on summarizing the uncertainty of exit, and I also told you typically the 3 modes of exit, and worldwide these are the only 3 modes. You will get the next fund to buy you out. There will be what we call as a strategic sale, a company buying you out, or an IPO after several years. So those 3 modes are how you will get an exit, and there's uncertainty for all of them. Okay. The other risk is, of course, when business plans get made, a promoter will say, the founder will say that this is how it will happen. My company is right now valued at 5 crores, it will become 50 crores, and so on and so forth. So you have to educate people that these are just projections right now, Excel sheet projections, etc. You can get much lower returns despite the company doing well. So I think this is an interesting point that you need to note. Okay. See, because here I discussed in one of the very first slide that the promoter is working to increase shareholder value. Now it might so happen that your company has grown, sales are up, maybe it is even profitable, customers are up, and so on and so forth. But you recall that you are going to get an exit or returns based on the next investment's valuation. So it might so happen that by the time you get to the next round, this sector is not doing well, or companies in this sector are not being favored. And I will also talk about it in a moment. That remember, this is like the stock market also. In a sense, it is like a private stock market, all of this venture capital funding market. And if you see, even in COVID, the stock market was going up. So what was the logic for the market going up? So the market follows its own logic, international funds coming in, China on the down, and so on. So there are so many factors, right? So your company might be doing well, and yet when it goes to raise funds in the market, there might be other factors because of which both might happen. Huh? It might get great valuation because so for example, Zomato riding on the fact of work from home, people are, they were blessed in that sense that hotels were shut and so on and so forth. Now all of this came together. So apart from the fundamental thing of a large company and so on, they were also benefited in that sense by COVID, and people are ordering from home and hotels not doing well. So such factors also come up when valuation happens at the next round. So when you say, but here I'm talking of the risk. So I'm not talking of the pluses that might happen and the benefits that might come, etc. I'm talking of what might go down. So for example, during this, when your company goes for raising the second round of investment, it might be possible that technology would have changed, concepts might have changed, a new competitor might have come in who is healthier or who is more favored and who is more fancy, for example. That might happen. So there is always that fight between, say, Zomato, Swiggy, and so on and so forth. So similarly, there will be fights in the market. So other competitors might come in. So there might be situations, there might be disruption in the whole setup. A very simple example that I can give you, for example, and something which I've seen very closely as a case study, is Meru cabs when they started was extremely innovative. Something that they call as a radio taxi. They were there in all of the airports. So they were better than the Kali Pili taxi. And they revolutionized the way we traveled, because now you had an AC car, you had a water bottle and newspaper and a good quality driver, etc., etc. So a safe and so on and so forth. So people started using them. And it was growing. So their model was go city to city, be at airports and so on and so forth, and parking and so on. Now, they could have done a fantastic, they could have grown. They were the number one. There was nobody like similar to Meru cabs in India for many years. But suddenly Ola and Uber came and disrupted the whole thing. So disruption is a big thing in the startup world, that a new competitor comes and does things very different as compared to what is being done traditionally. So did Uber come and say that I will have more taxis or fancier taxis or better quality drivers? No. A competitor should have come and competed based on these parameters and beaten. But they came up with an app and they came with instant taxi and so on and so forth. So you need to understand that disruption can happen in a very different way. So these startups are always afraid of disruption, and hence they are acquiring startups, they are hiring new talent, they are continuously innovating and so on and so forth. So again, I will give Zomato examples for a simple reason that it is fresh in our mind. There was an IPO recently. So for example, Zomato, what was Zomato? When they started, they were an app for giving details of hotels on which you could go and see a review, check and go. It's a nice review and you could find out. And what are they doing now and getting major source from is home delivery. Was that their model earlier? No, that was not the model earlier. Their model was very different. But they saw Swiggy, they saw what was happening there. They realized that a trend was changing. So they are constantly watching, and they were smart enough to sense the trend, that a trend for eating from home is increasing. Okay, now just for your information, the disruption is going to happen in what is called as dark kitchens. Some of you would have heard what dark kitchens are. So what the Zomato and Swiggies of the world are doing is, today you have now gone one step ahead, where imagine that 60-70% of the things that get ordered basically is routine stuff, right? It is idlis and vadas and dosas and Punjabi food, etc., which is pretty standard, or pizzas, etc. Now, these people have got database of who has ordered, when has he ordered, and everything. So they have the artificial intelligence which they can run on based on this data, and they can even predict that Vinit Deo orders every week, or Vinit Deo orders maybe, there's a chance that he will order on Saturday. So they can send me an update saying, look, 10% discount if you order a pizza today, and there's a good chance I will take, because they know on 3 Saturdays out of 4 I eat a pizza, for example. So what they're doing is, they will simply say pizza. Now they are not saying Pizza Hut or Domino's or whatever that is, right? And I may not care. I will say, pizza 50 rupees or whatever, 99 rupees pizza mil raha hai. So I'll just press order, and that goes to a kitchen which is unbranded, which is run by Zomato. So they will actually become a manufacturer. They'll become a producer of, they have already become actually, and they will have their own brands, and they will simply say ABC Pizza. While ordering, you will not know कि वो pizza. I mean, they will check it as Pizza Hut ABCD, but then you will see that X pizza is giving discounts. Will order. The reason I'm giving this longish explanation is, when you are talking to, and you should know this as you are getting into the ecosystem, as understanding startup, is disruption is a big thing. So you have to ask your founder, if somebody comes to you saying I'm doing a startup, that has he got that orientation? Has he got that thinking of disruption? Is he capable of being in this kind of a market? Are the questions that we need to ask. And because of these reasons and market forces, that is my next point, that you can get lower returns than expected if a other entity completely disrupts the market. Lastly, you should also then educate a that one is, of course, illiquid hai, theek hai, it's got stuck up. Uncertainty, the investor will say, chalo, aaj nahi milega, parso milega, whatever it is. low returns is also okay. But last is that it is very much possible that complete capital is lost. Now, this can happen if you are investing very early and the product is under development, will be sold later, technology is under development. So such stages are very risky for individual investors to invest. Typically, even when we advise, we look at companies where at least the revenue has started, the product has been launched, there is some month on month, what we call as traction, which is some month on month revenue, which is going. Yes, it might be making losses. But if you are investing in a company which is just setting up, developing the app, not yet gone to the market, then the risk is very high. The risk is that it may never take off. Customers may never accept it. Okay. It might be just a few, they may never grow that big, and so on and so forth. So there is a risk of partial or total loss of investment in venture capital that you should know. This is and it is very much possible that you might be doing well, but funds are not taking interest for various reasons. So which means ठीक है, loss नहीं हुआ, it is stuck, but you are not getting your money back. Is in a sense loss, because, or it might be that company itself goes completely down. The money which has been invested has not gone in assets; it has gone in operations and development and so on. And hence it's a loss, it cannot be recovered. So this education needs to be at the same time done to the investor if he is not educated in that sense. I'll again check questions if any. Okay. Okay. Now the thing is, when we say introduction to investing in startups, this is the crux of what we are discussing. What should you look for in a startup? It is almost Anirudh, it's almost 7 right now. This will take do we want to take a 5-10 minute break and then start? If people want that, then we can. It's 6:55 almost. We can reassemble in 5-10 minutes. It's
fine, sir. If you want to take a half break, we will do in that way. No problem.
Before I start this slide, because this is a very quality slide. I want to take people case by case. So we'll just take a 5-10 minute break. Huh?
Perfect. So we'll, back on 7. It's 6:54. So we'll get started by
at 7. Yeah. Okay.
Perfect. Yes, sir. So dear all participants, we are having a small break of 3 minutes and the session will get started again from 7 p.m. So stay tuned. We are initiating and starting the session. We are continuing it by 7 p.m.
Should we start?
Yes, sir.
Okay.
And we will be having question and answer session at the end of your presentation.
Yeah.
So I request all the participants to put your queries into question and answer chat section so that sir will answer at the end of his presentation. Please go ahead, sir.
Sure. Okay. So great. So welcome back. Give me 1 sec. Oh, so this is the crux of why we are here today, and the next couple of slides. What to look for in a startup. Some of the things which are not here in slides also we will cover as part of. I myself will cover, and as part of questions, whatever comes up, we'll also cover anyways. What do you look for in a startup? How should you evaluate a startup when somebody comes to you? And at the end of this, I will anyway share this with Pune branch, and they can put it up or share according to this presentation itself. Some of these questions which come up, I can also try and add some of those points in the presentation and then share, so it will be comprehensive anyways. So number one and the topmost thing that you have to look at is quality of. Oh, somebody's type. Is there a voice issue?
Not really. I can hear you properly. So there must be some network issues from the participants.
Okay. Fair enough. Just point out here.
Yeah.
So the number one thing that we look at is quality of founders, and there's zero compromise on this. So I forgot the name of very famous founder from the US. I'll tell you if I recall, uh, or support. I think it was Peter Thiel, one of the first backers of Facebook and of PayPal, who had said in one of his books that I go for a 11 out of 10 when it comes to hiring a person. So he was saying in that context, when it comes to a person. So it has to be an extraordinary founder. Now, of course, difficult to define doesn't mean fancy, great English, and so on and so forth, right? It can be a very earthy founder as well. And a lot of people have gone on to create great companies. But when you meet this person, what are some of the characteristics that you should see individually? Because see, it is this single person, okay, who is going to create this large enterprise, and that spark has to be there, okay? The level of energy, spark, enthusiasm, these become some of the soft things which are there. A combination of aggression as well as politeness. It shouldn't be that he's in his own world, thinks he's over smart and so on. So he should be smart, not over smart. So it is a right mix that one is looking at. Somebody who may not have, so depends again the level of startup or the type of startup. So for a technical startup, he ideally should be somebody who understands that technicality very, very well. He's an expert himself. He shouldn't say, I'll hire people and so on and so forth. So for a non-technical startup, yes, he should be a good, the sense that you should get is a good coordinator, good manager, good people skills. He should have timeliness, and then there's a lot of features that one can look at. But basically, in one line, if I have to say, one should not compromise at all. Forget compromise. It should be like a 11 on 10. He should have something which even you should feel is extraordinary. Even he's got qualities that even I don't expect, kind of thing. So of course, very rare to meet such exceptional people. And of course, then they go on to create 1,000+ crore or large companies. But somewhere closer to this ideal is what you're looking for in a founder, basically. So that's the very first thing. When you look at, when you're telling somebody to invest in a startup, the quality of the founder. Because even if problems come up, he then is capable of standing up to the occasion and solving them and doing what it takes and so on and so forth. Second, very, very importantly, immediately next, is it a large enough market that you are trying to service? I think what happens is, in normal companies, I'm saying nothing wrong with normal companies. When I'm comparing normal companies versus what we call as startups. If you are, for example, supplying, say, auto parts to, or even specialized or even technical stuff to a telco or a Bajaj or whatever. Now, there what happens is you are constrained by the size. There are 5 vendors, you are one of them, you are going to get so much share. And you cannot grow beyond what a telco Bajaj order is giving you, and their growth plan is fixed. Okay. So, versus a startup like a FirstCry, versus like a Flipkart, which can sell any number of products to any number of people. The people are also growing. They are growing all of Policy Bazaar and so on and so forth. Many of these people, they are continuously increasing their market share by going to people. They are doing both the things. On one hand, they are going to increase the market by going to more and more number of people. And number two, they are also increasing number of products and services. So it's a double growth that is possible in their case. So the market size has to be large, several thousand crore market size. If you're in a market size which is very small, so it's not just a size, I haven't mentioned it here, but it is also the features of the market. So for example, there are some markets which are difficult to service. A good example of this I love to give is the market for chai walas or serving tea in India is infinite. All of us are tea drinkers. Many of us drink 2, 3, 4 cups of tea a day. We like to go down, near our office, below our office, have a cup of chai, It is very prevalent, and people in suit boot also will go to a chai ki tapri and have a chai. This is a product which is there except pan India people. ऐसा भी नहीं है कि in Maharashtra, people drink or eat say puran poli, and in North India don't. ऐसा भी product नहीं है food का. It is like chai which is there everywhere in the country. And yet, what we have in India are chains which serve coffee, not tea, and they have become popular. Why is that? Okay, is there not market? There is market, but when we look at market size, we also check whether it is possible to, is there a serviceable market? It is called SM, serviceable market. So serviceable market means that when you say that you have these all of the chai walas and every corner there is a chai ka tapri. So Pune, for example, may have 10,000 chai tapris. So the question could be, can there be 100 of these? Like now there are chai point and so on and so forth, and there might be 100 cafe coffee days and so on and so forth. Why can't there be 10, 20, 30 similar like cafe coffee day or tea coffee day kind of a thing, tea day kind of a thing? So the answer for that is twofold. Number one is that we, as a market, we are used to coffee has a premium feel. We drink coffee in that sense on special occasions. Now, of course, people are drinking regularly. So it has become like a coffee shop that it is almost like a hotel. That's one. And chai is when you want to chill out. You don't want that formality of going to hotel. You just want to go down your office, walk over. Those who smoke want to have a smoke. Those who want to have a chat, meet people from other offices, meet friends, and just informally be there and just do some time pass and come back. Okay. And you want it to be cost effective. You would rather have it at 10 rupees so that there's no tension. You don't want the feeling of going to a hotel and ordering something and sitting something. That is the nature of the market. So when you look at a startup, we check whether the product you are doing, is it such that are you addressing a serviceable market, or uska zarurat hi nahi hai, or adopt hi nahi hoga, for example. So that is critical. Many founders come to us saying, I am doing efficiency, productivity increase in a certain year, etc. We also have to check that we are in India, when we are all checking, for example, in income tax side, it gets hung and still we are able to file returns. Last minute client gives data, and I'm talking in Indian context. Global VC ka context changes from country to country in Indian context, right? So we are used to doing things inefficiently because things are beyond our control. So somebody says that I will give you a fancy system for CA, whatever, office management, AV. It's very difficult because our clients are not organized. The regulatory parties are organized. So मैं अपना beyond the part organize करके क्या करूँगा? It's not of any use to me, for example. So things which increase efficiency, productivity, etc., sometimes do not help and may not, maybe needed, but people may not pay for it. For example, I ask a simple question that if tomorrow Gmail starts charging, despite your life being dependent on Gmail, you will shift to Yahoo. And that's the reason that neither Yahoo nor Gmail are charging right now as we speak. So there might be a need for a product, but people may not be willing to pay for a product, for example. Or Google Map, you will not pay, you will start asking directions again. You're used to Google Map. So what do? They don't charge, for example, for the Gmail. They have a new idea. They charge for the space and they charge for other features and so on and so forth to corporate clients, etc. So they have smartly found out ways of charging. So when we talk to startups, we check that, okay, you have a nice product, but will people, there might be need also, but will they be willing to pay for it? That is the next question. So market, serviceable market, and people willing to pay for it, or they want free only, for example. So news, if you see, was free a long time ago. Even now it is free. Recently now in Economic Times, etc., I've started saying that now they have quality, some breaking news, updates, and so on and so forth that they give for a premium. So now they have started charging premium for certain types of news. Okay. Then you have got, after you looked at a market size, we asked the founder, what problem are you addressing and what is the solution? So as I said, he might say, "Arey, chai ka dukaan hi nahi hai, to main chai, I'm going to have a range of, for example, tea shops." So we understand the problem solution statement, as we call it, and we spend some time there. Okay, is it really a problem? Again, is it a genuine problem? And will people be, as I said just a few minutes back, will people be willing to pay to solve the problem. That's why I give you a Gmail wala exam. Sending mails is a problem, but I'm not willing to pay for solving that problem. That's it. You serve me ads and use my data for ads, etc. I don't care. Aap wo kar lo, but my Gmail should be free or Yahoo should be free. So we critically look at this whole problem solution statement, what is trying to solve. Then stage of the, and here sometimes you have to talk to the client if there are already existing clients and so forth, so forth and so on. Just give me a minute. No, sincere apologies. So stage. So the next stage was stage of startup, which is next was stage of startup, which is are you at a seed stage, as I said, very early stage, startup few months away, or you have started revenues, you have developed the product and so on, and then you are already working. Generally, it is preferable that you are investing in a profit where at least revenues have started. If not revenues, there are some startups, for example, which in e-commerce stage, for example, or in online space, not in e-commerce revenues will start, where viewership would have started. Some other metrics or some other parameters are there, whereby business in that sense has started, that there are subscribers. So that those numbers can be checked as to whether month-on-month subscribers are growing and so on and so forth. So stage of startup is critical, and typically we recommend at least revenue starting, where then you can check up what is the growth of revenue, is it growing month-on-month, what is the quality of revenue, what is the yield, for example, per client, etc. Okay. Then very importantly, if a startup, for example, is looking at a 50 lakh rupee raise, you have to check up what is the end use of it, how long will it last, money. So you have to look at the cash flow. This money will last for, should at least last for a year, if not a year and a half. Okay. Then we look at, so this is called as a run rate, actually, like in the cricketing parlance. Run rate is how much, there's a revenue run rate, there's an expense run rate. So if we typically look at the cost ka run rate, that month on month, how much are you spending? Then I missed out funding needed stage wise. So apart from stage of startup, it is not necessary, it is not just sufficient to check कि अभी का round कितने का है और कहाँ पे पैसा. In the business plan, you have to check, okay, going from today's stage to, let's say, 10,000 users, it needs 50 lakh rupees. 50 lakhs will be spending so much in product development, so much in people, admin, rent, and so on and so forth. चलो तो वो, but 10,000 to 1 lakh के लिए क्या लगेगा? Does it need 100 crore rupees, 5 crore rupees? Because based on that, you have to decide कि the next round cannot be more than a couple of, your constraint is it can't be more than $1-2 million generally, unless it's an exceptional startup. So if it is going to need 50 crore rupees, or so that is very difficult to raise. After 50 lakh rupees, at the best, you'll be able to raise 5-10 crore rupees. So if he says, no, next round 20 crore lagega, so it's very red flag right now at this moment. So stage wise, you need to check. Other backers or investors also need to be checked. 50 lakhs, you are putting in 10 lakhs. You should never put in the money till that at least that 50 lakhs is closed and all money comes in together. So at least there is a clarity 50 lakh to bank mein. What is the quality of the people? Who are the others joining in, etc. is also important and needs to be checked. Very, very importantly, competition from other companies, especially funded companies. So as I said, many times the ideas are not, what can we say? Completely novel. There are companies in this space. Second is that even if they are not immediately competitors, there might be similar companies who are solving the same problem. So you have to also look at and study ki you are starting now. There are otherwise companies who are also working. You are trying to do a better product, better service, but it is very difficult to change. So it is like saying that, okay, I am coming out with a newspaper better than Times of India. But still, my habit is there for the last 30 years. I will not change Times of India. Or I will not drink Taj Mahal chai. Or I will not change Taj Mahal chai. So it is very difficult to change preferences. So the point is, if there are already competition, other companies in this space, it becomes very difficult to change that preference. There's a third point which is missing here, so I'll just speak it out. How to identify startups from where will come? So 2-3 sources. One is your own professional network, so CA, CS, and so on and so forth, where you should be there in the community and so on and so forth. Second is, of course, news sources when if you're tracking a sector, category, something about so that's the other thing. Third is effectively by being part of other associations. So there's a Maratha Chamber, there's a TI, the Indus Entrepreneurs Pune, and so on and so forth. So there are these organizations which one can identify, become a member, try and attend programs, and so on and so forth. So basically, like there is ICAI, here you join industry associations, and there you will network and meet people who are starting companies or wish to start companies. Next is due diligence. So after having identified a startup, having looked at promoter quality, all of those aspects and so on, what do you look at? How do you do due diligence? This is another opportunity that chartered accountants, all of us should explore, because even if you're not in the investing space, either getting a company if your client is a startup, then getting him ready for funding, or you yourself being part of a network which does these due diligences is a good opportunity. So there is legal, which is patents, copyrights, if any, the kind of software. So here you might need help of a technical person. Then the technology itself, how has it been developed? How has it been, which is the framework which has been used, and so on and so forth, whether it is latest, etc. Again, for the first couple of things, so the first you might need help of a lawyer. Second, you might need help of some software guy to check. Then very importantly, something which is not very common in normal organizations is that here, if you're, as I said earlier, startups are looking for huge growth, hundreds of crores of growth. So processes are very important. Even if it's a 5 people, 10 people company or a 2 people company, whether the thinking of the promoter is process oriented, he wants to set up systems, processes, etc., is the key. Then human resources. So one, as I said, there's a quality founder, but has he taken a second in command? Are there people around him who are of equal quality, good quality, and so on and so forth? That interaction needs to be done. As I said earlier, clients, if he has got clients, what is the quality, local, international, regional, has he got them? So that needs to be checked. And financial, if he's already a history, more than a year, then you get capital, from where has it been introduced, what is the promoter's profile, his net worth, what are the balance sheets, are there any liabilities, other loans, other commitments, has he borrowed, for example, earlier and that loan is upon him, for example, all of that. needs to be checked. Okay. Yeah, the second last slide, and then around in about 5-ish minutes we'll stop and go for question answers. In financial analysis, we typically look at a 5-year annual plan, but we ask from, we create, or we ask the startup, we work with the startup to create the plan, which is a comprehensive plan. It's not something like we give to a bank where we say last year turnover 10 crore tha, 10% increase. No, we go from bottom up, check products, types of products, rate increase, rate decrease. All of that has to be built on as a proper 5-year plan. People, number of people, designations, everything has to come in. And the same plan, then for the first year is very critical. It's a golden period basically, because it's make or break. So for the first year, we make a monthly plan actually, which is much more into detail because it's month-wise. And then comments are put there as to, what's to be done, what action points, who is to, etc. But that gives you a very clear idea. So when you're evaluating a startup for investment, this is critical. Cash, we generally at chartered accountants, we focus more on balance sheet and P&L. In startups, you have to look at cash flow, because cash flow is make or break for them. So if, as I said, 50 lakhs has been raised and monthly burn, as we call it, run rate or burn as we call it, is 4 lakh rupees, they are going to last 12 months only. Okay, so cash flow is critical. Whether in the balance sheet you showed higher loss, more loss, etc., P&L, that is not very important right now. Generally, most startups will end up making losses for first several years, and they will fund growth by taking funding from angel funds, VC funds, and so on and so forth. But are they moving forward is the key. Assumptions, more than the actual number of revenue and cost, the assumptions are critical. Sometimes promoters make very fancy assumptions of growth and so on. So that has to be questioned, challenged. They will say, "My sales banda lunga, 30,000 rupees salary." So maybe it may not happen. A 5-year guy might charge 1 lakh rupees. Simple things like that. Rental assumptions, overheads, travel expenses get missed out. That I want to generate so much business, so people have to travel. Now, where is travel? Where air travel, land travel? All of that will have to be factored in. Stays. Now that doesn't get. So these assumptions linked to the business. That is very, very critical. You can't say 5% of revenue travel. Waisa nahi hoga. You'll have to say, I got 2 sales guys. They need to travel so much, so many times, and so on and so forth. Then we have to critically look at a capex budget, capital expenditure budget, because most startups work on a very lean. They don't buy property. Generally, investors also don't like startups buying property. These days, so even computers are rented basically. So there's nothing that is owned. Place is anywhere rented, and so on. So typically, if there is a capex budget, it has to be looked at very, very critically, because it is a bad use of funding, and generally investors will not like money getting locked up in capital expenditure. So at the best, at the most, computers, etc., it's something that's fine, but otherwise nothing more. Lastly, as I said a few minutes earlier, fundraising assumptions. So right now, 50 lakh rupees. At what valuation tentatively is next year being planned? Next raise being planned? How much money is being? So those assumptions are critical, so that you understand that these are logical. Okay, it doesn't end here. After you finished, assume that you raised capital, it's being deployed. Then there's another opportunity for chartered accountants, and this is something that you should do anyways, which is compare business plans with actuals. Very, very critical. Apart from financials, the key, as I said, users, subscribers, client growth, revenue growth, per client revenue, all of those metrics, parameters have to be judged, because they are like a pathology report of a startup. Then key deviations from that plan have to be questioned, because that might be change in strategy and so on. Similarly, promoters might add, delete product services as they go on to, there's nothing wrong with that, but investors should be aware that this is happening in the A. Similarly, because new region, new geography being added poses risks So for example, if you are thinking that first year the startup had planned that they will only do Maharashtra, Pune, Bombay, etc. And suddenly after 3 months, you see business is also coming from Bangalore. And okay, business aa raha hai, acha hai, revenue hai, etc. is fine. But that might also have risk. So where is the money going from? Has he taken a sales executive there? If he is taking a there, then what about our cash flow? So those questions need to then go out, and then it has to be approved. Okay, this is fine. Similarly, as I said, key people, additions, etc. Those need to be checked and approved by the investors and reviewed by us. So I think we are at around 7:30. This is what I had to share from the entire, from the perspective of investing in startups. There's one question I think there, which I will tackle, and then we'll go for more questions. Take a second.
Yes, sir.
Yeah.
Dipti was asking that difference between VC or alternative investment fund or crowdfunding, and what is a suitable mode to invest in startups for retail investors who want to diversify?
Correct. So I'll answer this one by one.
Yeah.
Question one, what is the difference between VC, that is venture capital fund, and an alternative investment fund? They are the same. Venture capital fund is the business name that you use, a common parlance ki VC funds, etc. In the US, they are called VC funds and so on. So India, we started calling them VC funds. Technically, these are all registered under Securities and Exchange Board of India. And as per the SEBI guidelines, the name given, technical name given to VC funds is an alternative investment fund. That's it. So sometimes these funds are also called private equity funds. You will hear the name PE fund. PE fund is also an AIF, except that VC fund make investments at early stage startups. A private equity fund makes investments at slightly bigger companies. So that's a VC/PE fund is the same, and VC fund is the same as an AIF fund. That's question one. Second question is, what is crowdfunding? Okay, so there's one aspect. In crowdfunding, what happens is, technically it is not in VC, it's technically not crowdfunding. It is called angel funding, but I'll explain to you crowdfunding as well. Crowdfunding is nothing but there are many crowdfunding sites whereby a company can list. There's something called as angel list, for example. This is a platform, so they can list on this platform and say that I need to raise 1 crore rupees, and these are my description and summary and blah blah blah. There are hundreds of investors registered in that platform, and they will check, and if they have an interest in the company, they will contact the company, and so many people will get together. And because it's a crowd of investors out there and you are collecting money from the crowd, it is called as crowdfunding. But that is not so in VC parlance, we don't call it crowdfunding. Technically, like there are VC funds, there are angel networks. So there is India Angel Network, there is Mumbai Angels, there is Angel List, and so on. These networks basically are a group of investors who have organized themselves in a structured fashion. So there are hundreds of investors. They have an office, they have a team of analysts, chartered accountants, MBAs, etc. And when a startup pitches to them, they go through a process, and then 5 or 10 or 20 of them might put 5 lakh, 10 lakh, 15 lakh each. But there is a process that they will follow. So that this is virtually like organized crowdfunding. Suitable mode to invest in a startup for retail investors who want to diversify. Being part of one of these networks is the best way to diversify. There are advisors like us who put together, so what they are doing in hundreds of years. For example, we have a network of 15-20 angel investors. We pitch proposals to them. So there might be more chartered accountants, MBA, etc., who may have these opportunities. You can approach them, for example, or you can approach us, for example, where we can showcase opportunities. And in addition to that, they can go to this angel network. So the question was, how do you approach? You approach people who are working in the system, and they will have access to the startups. So
There is another, question from CA Dipti ma'am. So she's asking that there is a tax exemption under Section 54EE for long-term capital gains for investing in startups. But how does one invest and get exemption?
I did not understand how. I mean, how does one invest and get samjha nahi mujhe? I mean, you invest. I mean, so how? If you are there, can you spell out your question? Meanwhile, I will address one more question. I will answer one more. Is it better to invest in mutual funds having criteria? So mutual funds don't invest in startups, just to close that loop. As many times comment may not have, yes, that is what I was replying to CA Dipti Thakkar, that instead of, it is very difficult for individual investor to invest individually, because as I said, so many things have to be checked before you invest. So it is better that you are part of a angel network. Or see, venture capital funds, the minimum criteria for many of these funds to invest, if it's is 25 lakhs to a crore of rupees. So if you want to invest in a venture fund, like in mutual fund, there might be, let's say, 1,000 rupees or 500 rupees. In venture capital fund, if you have to invest, which invests in startups, it is 25 lakhs to a crore. Whereas in angel networks, that limit is 5 lakhs to 10 lakhs. So, but the advantage of angel network is you get the benefit of due diligence and everything done by them. So it's, and plus so many people are investing, so it's safe. So it is, yes, definitely safe to invest through a network than individual. Okay.
So another
there is one more.
Yeah. Yes, sir. So he's asking that if startup investing is a private investment, then how can SEBI is regulating them? And further, he's asking, it means for investing in startup, one has to register with SEBI. Then how can retail investors like us can put money in startups?
Okay. Okay. So number one, investing in a normal startup investing is not regulated by SEBI. I said the funds are the alternate investment funds are regulated by SEBI. So you cannot pool in money. So if I want to collect money from 10 people, and that is called pooling of money, that pooling of money is not allowed. But if I want to directly put 10 lakh rupees in a startup, there is no restriction there. But if I want to collect money from 10 people and say that I will invest in a startup, that is not allowed. I have to register with SEBI.
We are having another query, sir, from Parvati, that investment in startup seems to be high risky. In common parlance, most of the angel investors are from high income group. Is investment in startups are healthier for individuals?
See, this is it's like asking ki, investment in stock markets are also risky. Okay, so first of all, retail, uh, you know, it should be done only by high net worth investors, in my view. Okay, because it shouldn't be that you are doing as a substitute to investing in stock. So somebody who's mutual fund quota, stock market quota, somebody who's well settled and is aware that if he puts 5-10 lakh rupees, that money might be lost. Only that. So you can imagine, and you can do your own working. So that, as I said, that's why we have to educate. Now, I may have a crore of rupees in liquid money, for example, or my investments are done. I'm well settled, and I'm okay with investing 5-10 lakh rupees every year or every 3 months or whatever it is. So that criteria, as a part of financial planning, has to be done by the person and the chartered accountant or his planner, as to what is his personal and professional planning, how much money can he set out. But whatever money he sets out, has to be clear, it can go or get stuck up. That's number one. So whether I have 10 crore rupees and then want to lock up 10 lakh rupees, or I've got 3 crore rupees or 1 crore rupee and lock up 10 lakh, that's an individual choice. That's number one. So there cannot be a generic one size fits all answer. But yes, I agree with CA Vermaji's point that it is risky and shouldn't generally be commonly done. Okay, कि ऐसा, it shouldn't be suggested कि sir आप stock market में कर रहे हो तो आप startup भी करो. Not advisable. Okay, all of these risk factors that I've said, and let the client take a you yourself understand and let the client take a choice. From a healthy, so question is healthier ka na? One of my first slides I have said that it is another asset class. Like you have got gold, real estate, mutual fund, PPF, and so on and so forth. So after you have done with all of these asset classes, okay, everything gives a certain type of return. So gold might give 3%, PPF might give 7%, and so on and so forth. Now, this asset class can technically give you whatever 30, 40, 50% return also, with the downside being capital can go. Now, if you are willing to take that kind of a risk, okay, and to give you an analogy, it is the same way that, for example, when people play in the derivatives market or in the options market, they are anyway taking obviously not so much risk, but anyway significant risk anyways. Now they are betting and so on and so forth without, and that is many times technical betting, not even with respect to fundamentals. Here at least there is a significant degree of fundamental analysis which goes on, as I said, quality of promoter, technology, and so on and so forth. And still, yes, something can go wrong. So with that fundamental analysis, you are investing, and with a good chance that the 10 lakh you put in becomes 50 lakhs or a crore. Now that possibility is there. That possibility is not there in any other asset class. And that is the reason that hundreds and thousands of people have now started investing. The other reason that people have also started investing, and how I should also tell you how the risks are coming down and why is this trend going up, is that now there is a depth in the market. 10 years back, there may have been 50 funds. Now there are 500 funds. Now there are funds who give everything from 25 lakh rupees from an early stage, and there are stages of funds now. So that ecosystem is well established. So if the first investment happens and you do well, there is a second round investment called as a pre-series A investor or a series A investor, the series B investor. So like there was no depth in the stock market earlier, it was risky trading. Now there are insurance companies, banks, there are institutional investors, foreign players. So with that, there is a depth and liquidity in the stock market, which reduces the risk. In the VC market also, now you have got hundreds of, right from angel investors to AIF funds to PE funds to sovereign funds. You have all of these people investing. So if your company is doing well, there's a good chance you will get liquidity, that somebody else will come in, put a second round, third round. That chances are now very high. And that's the reason it is becoming popular. Without that, it was very, very risky.
Mm-hmm. So I request participants to ask their query, if any. Sir, meanwhile, I also wanted to ask some question, if you allow me. Yeah. So basically, one of my brokers, called me one day that you can invest like in the company's pre-IPO as well. So he gave me an example of Chennai Super King, that that share of that company may also get listed by way of IPO in coming few years. So is it such kind of concept actually available or running in the market, and how risky or how feasible to invest in such companies that is pre-IPO? Because we are just having judgment that such company may get listed by way of IPOs, and if we invest now, that is before they announce their IPO, it will be beneficial for us. But do you want to say anything? And do they come under startups? How exactly?
No. So they don't. They are not technically startups because they are very large enterprises, large companies.
Mm-hmm.
Yes, what you are seeing does happen. Many times these ticket sizes are also large, maybe 10 lakhs, 25 lakhs. The sizes are also large of the investments.
Okay.
But the risk is basically there unless you have confirmed news of listing, etc. That is the risk that you carry.
Correct.
You should know someone, the person referring, the broker, कि ये होने वाला है. Otherwise, it's too tricky and risky.
Correct.
So there are some people who invest like that because they have this innocence inside news. Technically, it's not because it's not listed, so it's not inside news. So it is. They have this confirmation.
Correct. Right.
But yes, if you have that information, people have got good returns investing like that. CA Navandarji, I think, has no. So Tejas Shinde, she has asked pre-IPO. No, not grey market. These are actually officially. So sometimes there are shares belonging to the employees. There are shares belonging to the promoters. So such shares are available, or first round investors, etc. So those shares as a private limited company can be sold, right? So they are sold.
Right.
CA Navandarji, I think, has raised his hands if he wants to answer something, ask something.
Please ask your query in chat box because we cannot unmute you. There is no option as such to unmute the participants. So it would be great if you through Q&A, that is question and answer chat only. CA Dipti is again asking that how does one access unlisted shares? How does one buy? I think she wants to ask that how does one can buy?
So that is, it is only through brokers. So it's not listed anywhere, etc. So it is through broker network only. So you need to connect with them. He will connect to somebody and so on and so forth. There's no organized system there.
Correct.
In short, which round investment provider risk reward ratio is?
Which round investment provide risk and rewards ratio is high?
So generally, if you are there in the first round, that is the angel round, what happens is typically valuations of a company that we have seen are between 10 and 20 crore rupees. Okay, and then they can keep on being 50 crore, 100 crore as the company grows, or it might get stuck up there. So at the 10-20 crore level, the risk reward ratio is high because then typically the people have got 10x, 20x, 100x returns also. So in short, the first round, first or the second round, let us say.
Right.
Then the multiple key, because the first round galaga is infinite return. Na? The second onwards, it keeps on getting limited.
Correct. And IPO, I think IPO is third stage, is it? Or how exactly?
IPO can actually these days now, investments go on to series F, G, H, I, J. I mean,
okay.
Yeah. So if you see the news, sometimes they'll say now series F investment is also common. They keep on $100 million to they keep on investing in larger companies till they achieve a certain size, and then ultimately it's IPO.
In meanwhile, Tejas Pradeep Shinde is asking that who all are the statutory bodies regulating startups?
So startups are not regulated by any, because startup is effectively what? It's a limited liability partnership for a private limited company. So it is registrar of companies. That's it. So there's no separate regulator for startups as such. SEBI regulates the funds which invest in startups. That's it. There's no separate regulatory body there. I'm on this slide, my contacts are there. If somebody wants to, I'm there on WhatsApp, email, and so on. Both presentation also, Anirudh, I will share. So
Yes,
we will, so happy to answer. This is an area of passion. So we've been doing this 15 years, interacting and seeing the early days. So anything there, and there are a lot of misconceptions. The other thing also, as I've seen, there are a lot of fancy ideas, misconceptions. Some chartered accountants very rightly pointed out and realized today that sometimes their own clients end up getting stuck by investing in fancy ideas. I think that can also be a role of a chartered accountant, where tell them, let me at least evaluate or do due diligence of this company once, instead of just putting in let me check do they meet this business financial बाद में आएगा वो Excel plan और ये देखे क्या करना है ना, what is the promoter that we, so many chartered accountants here can do that. Now we have a good business sense, so we can understand with them and tell our clients, don't just put money, we'll evaluate.
Correct.
And that's why people many times just have the fact that एक रुपया डाला तो 10 रुपया होगा, or startups, fancy words. So people don't realize that, as I said, as a criteria, startup has to meet a very high bar of expectation. It cannot be anything innovative and so on. So as I said, innovative, sometimes it cannot be innovative, but it's just the need of the hour. Okay, ideally it is innovative, there is a serviceable market, the pricing is right, there is enough money. So a lot of things have to come together to make a good company. It's something people get drawn to, fancy idea, maybe a nice promoter, nice presentation, innovative something, e-commerce. These become very buzzwords basically, fancy words, and they go after it. But it's not that. It's very, very difficult to make something worth few hundred crores. Is extremely difficult. And one last point I want to say is, converse can also happen. As a chartered accountant, if you see any balance sheet P&L of a company which is growing fast, ulta bhi ho sakta hai, where you can talk to them saying, why don't, yes, startup is just a name, it's LLP, private limited company, just a concept. You can also encourage that promoter saying, you can grow fast. Why aren't you growing fast? That is also very much possible.
Right.
And I've seen cases where we have gone and given ideas to companies and raised good amount of capital, where we felt that the promoter was nice, there was a process involved, he was doing something innovative, where the promoter himself was not aware that he has got potential.
Right. So it's almost 7:50 and we have almost covered all the queries participants have asked.
Sure. Do we want to stop?
Yeah, we'll just conclude this by the vote of thanks. So we have reached to the end of this beautiful and informative webinar. Now it's time to have vote of thanks. Well, today I see Anirudh Rathi take the opportunity to put my gratitude into words. The best and beautiful things in the world cannot be seen or even touched, and they must be felt by heart. And thank you is one of such prayers among them. So on behalf of ICAI Pune and all the members, I would like to extend my heartiest thanks to our honorable speaker, CA Vinit Deo sir, who gave his vital time from his busy schedule to grace this webinar. Thank you, sir, for enlightening us with your informative words and such a huge experience you're having. So it is always beneficial. And the examples you gave, like Chai Wala, that was so simple to understand us. I also thank CA Samir Ladda, Chairman, Treasurer, Pune ICI, and CA Kashinath Pathare, Vice Chairman and Secretary of Pune ICI. And of course, thanks to all the team members of Pune ICI, and most importantly, all the attendees and participants to this webinar who have helped us in making this virtual investors awareness program organized by Pune branch of WRC of ICI to such a big successful program. And thus I now conclude this session here. Thank you so much. Thank you, sir.
Thank you so much, Anirudh. Thank you everyone for being a patient and nice audience. Thank you.